Hello, everyone. In my today's video, I'm going to talk to you about a company called EFC Limited. So they are mainly into leasing office spaces. So we'll look into their model and we'll see why is it very different. Okay. So if you look into their model and how they make money, so first their core business model is manage office space. So what they actually do is right. So builders construct, office space, and what they do is they go to them and they lease these spaces from these developers. And then what they do, they convert them into offices and then lease it to corporate clients. So that is their first and the main business model. Second is they have a design and build model. So what they do over here is right, they just don't lease spaces, lease office spaces. But if a company who's setting up a new office and they want to design their office, they provide that services also. So they do the whole interior fitting completely, and they do this completely in house. And the other and the last thing that they have got into recently is furniture manufacturing. So, and the reason they have got into this is because earlier they had to, when they used to give these spaces for to the companies, they had to procure the furnitures and everything, for which they had to go and buy out from the suppliers. So, but and they realized that because of that, the margins were getting affected and it was not that feasible. So, what the company did, they decided to buy out a furniture company completely. And so now they manufacture their own brand called Mirove. So now what they're trying to do, they're trying to control the whole space. It's not just leasing offices, but from leasing to design and building to supplying the furniture, they try to manage everything. And if you look at it, how they make money, right? So first is rental arbitrage. What does that mean, right? So it means the spread between the long-term lease that the company pays to the landlords from whom they have leased these spaces, and then obviously then they forward lease it to the corporate clients, and the difference between both of them is that's how they make their money. And obviously their second thing is services fee. As a corporate client takes these offices on lease, they need someone to manage it and take care of these offices. So the company provides that services also, and obviously through contract billing, where they do the interior design and fit, and the product sale, which is sale of furnitures. So let's look into the recent result and how did they do. So recently the result came up and their revenue was up by 52% to 270 crores from 177 crores last year. PAT was up by 43% to 62.4 crores from 40.5 crores. Earning per share was up, but only by 4%, that is to 4.61 rupees from 4.43 rupees. I'll get into this later and explain to you why did this happen and why it can be a good sign or it can be a bad sign in the future. Okay, so let's look into their operating margin. Their operating margin was down by around 41%, from 52% last year. This was mainly at the back of the way they calculate or do the accounting for it. That was the main reason. And the other reason is obviously as they are acquiring new businesses, like they've acquired the furniture business and they've acquired this interior company called Whitehill Interiors. So that has currently impacted, and they are hoping that they will get the operating leverage later. And if we divide the revenue between their three business model and we look at it and how well they grew. So if you look at the leasing business, it grew by 40% year on year. Design and build segment was the main one, which grew up by almost 76% YOY. And the furniture segment grew only by 16% YOY. And the reason is why, because right now the capacity utilization of this factory where they're manufacturing is quite low. So the management is trying to target capacity utilization of around 40 to 45% by end of FY26. And they want to double this capacity by the end of FY27 to reach around 80 to 85%. So let's look into what are they doing to grow. So first of all, we have understood from the business model, the way they make their main money is by leasing office spaces, right? And for that office spaces, they require seats. So currently they have around 57,000 seats, and they're planning to, increase these seats from to almost 1 lakh to 1 lakh 10,000 in the next 3 years. And the other thing that they're trying to do is, right, they're trying to get into retail leasing. So what does that mean? So they're trying to lease out, spaces in malls, and that in for premium showrooms, and especially in metro and Tier 1 cities, and they plan to lease it to the shops or the the retail stores which are trying to look for these shops. And the other thing that they're trying to do is, right, they are trying to launch India's first small and medium real estate investment trust. And the reason that they're trying to do is, right, because this will allow them to move the assets currently which they have on their balance sheet, and it will free up the capital for future expansion and will help them earn management fees. So that is one of the other things that they're trying to do. And obviously, the only way a company can grow is when they expand into other areas of India. So currently, their main exposure is to the west of India. So they are trying to expand in south and in the north side also. And obviously, where their main business is currently, which is in Pune and Mumbai, they are trying to increase the number of seats over there. So, what could be the challenges? Obviously, the challenges could be the leasing issue that they might have, or if the capacity utilization of the furniture business doesn't pick up as expected, that could affect the revenue as well as the operating margin in future. And the other thing which the company does is has done is, right, they have diluted the equity. See, whenever a company is growing at a very fast pace, they need money, so they can either generate the money from their own business, or they can take a loan from the bank, or they can raise money by diluting the equity. So in this business model, as it is a very capex heavy business model, because you have to lease so many of spaces upfront before you can give it to the corporate clients, it lot of money is stuck, so the cash flow is not that great at this point of time. So they are not able to generate too much of put too much of their own money. So but the company has not gone for the loan option. What they have done is they have increased their diluted the equity and increased the number of shares from 68 million in 2023 to almost 100 million in 2025. In this way, they have definitely you know generated the cash to expand the business, but the impact was on the shareholders, because we need to understand, right? See, the value gets added to the shareholder only when the earning per share increases. So let's take an example. If there were only 100 shares and a company earns 100 rupees, so earning per share is 10 rupees. But let's say the company dilutes that 100 shares to 1000 shares, and even if the company earns you know a hundred, let's take 200 rupees, right? It has to be divided between those 1000 shares, not on the 100 shares, because if they would have earned the same 20 rupees on that 100 share, the earning per share would have increased to 20, which is almost 100%. But because they had to divide it to almost 1000 shares, it falls down drastically. And that's what has happened. And that is the reason why, if we see, the earning per share currently has increased only by 4% because of the dilution of this equity. Now, all we have to do is wait and see, because if the company is able to grow, generate more revenue and more cash flow and more profit, then this will not have that much of an impact, because the earning per share will definitely increase. But at the same time, if they are not able to do that, it will definitely have a negative impact. And the other thing that we need to keep an eye is, like, they don't keep on diluting the equity. So no matter how much money that they are earning, they will still not the shareholders will not benefit, because the equity is diluting. So let's keep an eye on this business and see how well it does. So if you like this video, please do subscribe to my channel. Thank you and God bless you.